Alright, so in this class what we want to do, I always want to do a quick review of what we've done in a prior class or prior classes, but then we'll get into the major asset classes and sub-asset classes. Last week we covered the major asset classes, and now we're getting into detail, and today we'll get through cash and cash equivalents and then get into a really fascinating topic, which is the fixed income, the bonds. I use an acronym DC cuts I, and you'll see how we'll walk through that acronym over the next few classes. Some really interesting stuff. I think some of the most exciting stuff in finance. So let's start off with a review of what we did last class. So remember, last class we defined a portfolio. A portfolio is a collection of assets, which is both assets and includes some securities like stocks and bonds, that a person holds in order to fund some future liability or some future purpose like retirement or college education. And if someone comes to us and says, I want to build a portfolio, there's three questions you should ask them. First is why? Why are you building the portfolio? What is that liability, that future cash outflow that you're funding? And remember, we said the most important question asked there is their horizon. When, how long do they have to invest? When will they start drawing on that money? How long will they need it? The second question is what? What can you invest in? And there's where we talked about being parsimonious, having enough asset classes to explain the risks that we're taking, but no more, so that we don't have unnecessary work to have to review managers that we have to hire for all those extra asset classes. And the last question is how? How will you execute this? And there we had three areas we talked about. Are you going to do it yourself or hire someone to do it for you? Hire a manager or mutual fund. We'll talk about those when we get into the second part of the class. What's your strategic allocation? Are you going to be tactical? Are you going to try to beat the market? Another way of talking about that is, are you going to be active or are you going to be passive? So as you build your answer to this massive exam question, showing that you really understand what we're doing here, those are the types of things you want to definitely make sure are in your answer. There you can go much further. Obviously with the parsimonious, I gave you a lot of extra discussion that you could do there, but you at least want to cover the concept in your answer because it's very, very important. So now what we want to do is jump to page 5 of the notes. We saw this last week, but just again to remind us, the four asset classes: cash, cash equivalents, bonds, stocks, and alternatives. So cash and cash equivalents and bonds. Here I want to cover really quick what we mean by bonds versus cash, because they're really the same thing. Both cash and bonds are you loaning money to someone else. And fixed income is you loaning money to someone else. So why do we distinguish between cash and bonds? And they're both just loaned money, money that we're lending. And the distinguishing characteristics that we make between these two asset classes comes down to two types of risk: reinvestment risk and price risk. So reinvestment risk is the risk that you have a loan, that you loan someone money and that loan comes due, that you get paid your principal back right when interest rates are their lowest. So let's say you loan someone money for 5 years at 5%, and so they pay you interest every 6 months. At the end of the 5 years, they're going to pay you that money back, and you get that money back, and interest rates are no longer 5%, now they're 2%. So you had this investment that was making you 5%, and now suddenly you get all your money back 5 years later, and the best you can do is reinvest it at 2%. That's reinvestment risk. That's a huge risk for cash and cash equivalents. In fact, cash and cash equivalents, they're so short term that they tend to be reinvesting all the time. So when interest rates fall, you see your income immediately fall. Versus if you buy a 10-year bond that's paying you 5%, you've got that 5% locked in for 10 years. It doesn't matter what interest rates do during that 10 years. You're protected from reinvestment risk during that time. So cash and cash equivalents have very, very high reinvestment risk. Bonds can have varying degrees of reinvestment risk. Short-term bonds have much more reinvestment risk than long-term bonds. We're going to use the word duration to explain that. We have long duration bonds and short duration bonds. So long duration bonds have very low reinvestment risk. Short duration bonds, short-term bonds, have very high reinvestment risk. And then cash is the shortest as you can get, the shortest bonds that there are, and they have very, very high reinvestment risk. But bonds also have price risk, also known as interest rate risk. And interest rate risk or price risk goes in the exact opposite direction. Cash and cash equivalents have very little price risk. When interest rates change, their prices don't change much. If you have a $1,000 savings account, if interest rates jump up or jump down, that savings account's still worth $1,000. You can take your $1,000 out. It's true your income's going to move up and down with interest rates, but the amount you have invested will just stay right at $1,000. So you have essentially zero price risk. But if you buy a 30-year bond and interest rates rise, that bond price is going to fall 15–20%. So you have a lot of price risk. You're very sensitive to interest rates. So you see these two things are complete contradiction to each other. Cash has very low reinvestment risk. Very, very high reinvestment risk. Cash has very high reinvestment risk, but very low or almost zero price risk. Long-term bonds have very, very low reinvestment risk, but very high price risk. And then bonds have everything in between. So bonds, you can have short-term bonds that have high reinvestment risk, but low price risk. Long-term bonds that have low reinvestment risk and high price risk. So what I like to explain it is cash and cash equivalents have high reinvestment risk and low price risk, and bonds have varying degrees of reinvestment risk and price risk depending on the duration. So higher duration bonds have varying degrees of price risk but less reinvestment risk. Low duration bonds have more reinvestment risk, less price risk. So how do you manage this risk? So you have these two contradictory forces, reinvestment risk and price risk. And the most popular way to manage the risk is what we call laddering maturities. You can actually look this up. This is another term you might put on that sidebar of things you can go out and do an internet search for. But you might look at, you can Google ladder maturities or even laddering CDs, certificates of deposits. You'll see web pages that help you do that. And what we're doing there is we have some bonds that are very short term, so they have very low price risk but high reinvestment risk. We have intermediate term bonds, longer term bonds, long-term bonds. So we have some bonds that are maturing this year, some bonds maturing next year, some bonds maturing in 3 years, 4 years, 5 years. So that's what we call laddering our maturities. So we always have cash maturing at all different times. So if interest rates shoot up, we have some cash maturing that we can reinvest at the higher rates. If interest rates fall, we have longer term bonds that have locked in higher rates to help protect our income from falling. So here's some other terms that you can do an internet search on. A bullet approach versus a barbell approach versus a ladder approach. A bullet approach is you have all of your bonds maturing all at the same time. A barbell approach is when you have about half your bonds maturing short term, half your bonds maturing long term, and nothing in between. And then laddering is when you have your maturity spread out over time. So laddering is the most popular, but bullet approaches and barbell approaches make sense as well, depending on what you think interest rates are going to do. Now, we're going to get into this more in detail, but we are really only going to be able to scratch the surface when we talk about bonds. But there are some books that you can definitely buy that are famous, very well written. Let me just show you a couple of these books. So this book's the most famous. It's edited by Frank Fabozzi. He wrote some of the chapters, but not all of them. But it's called The Handbook of Fixed Income. It's a little expensive. You could definitely buy a used one, but the used one's more expensive than the new one. I think it's a good book for finance majors to have in their library, but you could wait and see if you really need it. If you look at it, it's an interesting book because it really gives you a sense of just how complex fixed income is. So, if you look at the different topics. I don't know why we can't get to the first page of the index. So it's not showing us all the pages, but if you look at microeconomic dynamics and corporate bonds, we're definitely going to be talking about that when you do paper 1. Pricing bonds, yield measures, total returns, we're going to be talking some on this. Measuring interest rate risk, you can see on the DC cuts I that the first D is duration, the first C is convexity. We'll definitely be talking about that. You can see how complex it gets. The structure of interest rates, you should have had some of that in 3013. We won't get into that much. And then they get into individual securities, treasuries, agencies, municipal bonds. We'll talk about municipal bonds. Corporate bonds. We'll talk about corporate bonds. We're not going to talk about some of these structured debt, but we will talk about structured debt a little bit high level. So leveraged loan, convertible securities, structured notes, floating rate securities, inflation-linked bonds. We're definitely going to talk about inflation-linked bonds. In fact, I have this chapter 18. I have this as a separate book signed by Brinjo himself. I don't know how to say his last name, but he goes by Brinjo. He sent me his book with the cover signed. His book is just on inflation-linked bonds, but they took that book and made it a chapter in this larger book. We're going to talk about international bonds and talk about what happens when you have non-dollar denominated debt. We'll talk a little bit, not much, about emerging market debt. We're going to talk about exchange traded funds. We're not going to talk about covered bonds or preferred stocks. We'll talk very high level on structured products, but look at how many chapters are structured products. It just goes on and on and on. Huge part of the fixed income market. We're going to talk some of these, like mortgage-backed securities. We'll definitely get into those. But you can see we're only going to barely scratch the surface of this, what you could cover in fixed income. Now this is a long book. It's 1,840 pages. So if you bought this book and wanted to read it, if you read 3 or 4 pages a day, you could probably get through it. Maybe 6 pages a day. I doubt. And a lot of the 1840 is problems at the end of chapter and the index and glossary and those kind of things. So maybe it's 1,500 pages. So if you read 4 or 5 pages a day, you get through it in a year. It's not the type of book you would just sit down and read, though. I did do that when I was studying for the CFA exam. I did read through the chapters that were assigned, and I worked all the math problems. I really got into it. But it's a little bit of a tedious book. It's just there's so much complexity to it. But there is a book you could read on fixed income, and that's this book here by Bruce Tuckman, Fixed Income Securities. It's a much shorter book, so it's not quite so intimidating. So 640 pages, you could read the whole thing. You read 4 pages a day, you'll be done with it by the summer break. It doesn't get quite into the detail, but it does have similar topics to what you would see in the Fabozzi book, just at a much higher level. See the term structure models. Definitely talking about interest rates. One thing I like about here in his book is he talks more about strategies. That idea of do a bullet strategy, a barbell strategy, a laddering strategy. He talks about when you would do one strategy versus another. So it's a great book on strategy and understanding how to structure your bond portfolio to take advantage of certain opinions you have about interest rates. So both really good books. This one's the cheaper book. I don't know why the used books are so expensive, but I don't know what edition this one is. It's the 3rd edition. I doubt buying the 2nd or 1st edition would be all that serious of a problem. This book doesn't change. Maybe some of the data tables haven't been updated, but that's not a big deal. So definitely books that you could think about buying if you're interested in fixed income. I'm hoping in this section of the class to cover it enough to whet your appetite. So many undergraduate students, finance majors, when they think about investing, they just think about stocks. But over half the securities market is bonds, and I think bonds are an incredibly fascinating field. You can make just as much money analyzing bonds as you can analyzing stocks. You can make just as much money being a bond portfolio manager as a stock portfolio manager. So there's no economic reasons why you shouldn't do fixed income. And you're going to see in the next few classes that fixed income tends to be much more quantitative than stocks. So if you're more of a quantitative mathematical kind of person, you like formulas, you enjoyed your stats class, you might enjoy fixed income more than you would stocks. But it's just keep your mind open when you're applying for jobs. Don't assume to get on the investment side you have to be on the stock side. All right, so then we get into stocks. Stocks represent ownership in an entity. So we're going to use DC cuts I for bonds. You'll see what I mean by DC cuts I's there. For stocks, we're going to use bucks, B-U-C-S. So we'll cover that, betas, capitalization, style, and US versus non-US. So I have little ways for you to remember this, not to remember for the exam, but to remember it for life, to always just have this in your permanent memory. And then we'll get into alternatives, which is everything else that we haven't covered. So alternatives is really just everything else. We buy alternatives. You want to definitely get this into your exam answer. It's really important. There's two reasons people push alternatives. One is for diversification. That's probably the most important reason. But also a lot of alternatives also protect us from inflation. They provide an inflation hedge, especially real assets like commodities, real estate. Those tend to be good protectors from inflation. So you'll see, we'll go through a list of several of these. It's just everything else, but this list changes over time because a lot of time an asset class will start off as an alternative. It becomes so commonly used that it moves from being an alternative asset to being its own asset class somewhere else. So emerging market stocks is a good example. Emerging market stocks used to be an alternative. So emerging markets, we'll talk about this later, but it's countries that are struggling, they're not very wealthy, they don't have a very well-developed stock market. So, so a lot of countries, maybe Mexico would be an emerging country, even though it's a well-developed, a well-situated country and has some wealth, its stock market's not that well-developed, so it's an emerging market stock. China's still an emerging market stock market. And because emerging market stocks has become such a popular way to invest, it's no longer an alternative. It's now part of the stock. It's a sub-asset class under stocks, really since the 1980s. All right, so let's get into the very first asset class, which is cash. So cash is the one asset class we do not have subcategories for. There may be someone out there that does, but cash is usually a very small allocation. In fact, most people on their strategic allocation to cash is usually zero. So cash is not usually held as a true asset class. It's usually just a place to park money until you find out what you want to do with it. So cash represents loans to corporations and governments that mature in less than 1 year. That's the key. So remember what we want to do on the exam. You want to define the asset class, talk about subcategories. We don't have subcategories here, but you do want to give some examples of cash, and then talk about strategy. So the securities that represent cash are treasury bills. That's when you make short-term loans to the U.S. government. These are discount bonds. So they do not pay a coupon. They don't pay interest. You buy it at, say, 98, and then it matures at 100. So your entire return is the price change from the time you buy it to the time you sell it. Agency short-term securities, that's other loans. That's loans to other government agencies. Corporations, when they borrow short-term, it's called commercial paper. So short-term bonds to short-term loans to corporations. And then if you take all of these, treasury bills, agency short-term, corporate short-term bonds, put them all together, you would put them together maybe in a money market account. So banks have money market accounts, their checking accounts, savings accounts, short-term CDs, money market demand accounts. And then there are mutual funds that do short-term, money market mutual funds. So these type of investments would probably have a lot of these type of securities backing them up. So a money market mutual fund would buy commercial paper, buy discount notes and treasuries and those type of things. The characteristics of cash is, first of all, it has the lowest expected return. Now, it might have a better return than stocks if the stock market sells off 25%, but the expected return on cash is very low, especially today with short-term interest rates so low. The expected return on cash is pretty close to zero. Your checking account or your savings account at the bank is probably paying you 0.1%, if even that. Its expected risk, though, is also very, very low. As we talked about, it has very low price risk. Now, it does have reinvestment risk. It does have inflation risk. Short-term cash and cash equivalent type of investments tend not to keep up with inflation very well. Their returns move very quickly with current interest rates. I remember a gentleman I was talking to, he was bragging after the 2000 crisis about how smart he was to have all of his money in certificates of deposit. And like he didn't lose any money in 2008. Well, a few years later, I didn't talk to him, but I knew what he was thinking. Those CDs had all matured and they'd rolled over. Instead of him making 5% on his CDs, he was now lucky to get 1%. Which means his income dropped like 80%. He was using those CDs for his retirement income. So yeah, it's a reinvestment risk is a huge risk. The duration of cash, we're going to talk about duration, is that measure of price risk. How sensitive is the price of what you're buying to interest rates, and the duration of cash is zero, very close to zero, has very low price risk, very high reinvestment risk. Credit risk, we're going to talk about credit risk. That's the second C under DC cuts I. So it's the C of cuts. So credit risk is usually very, very low with cash and cash equivalents. Now, you have to be careful. In 2008, AIG and Lehman Brothers went under, and that caused some losses in some money market mutual funds, some pretty unusual losses for them. But credit risk can be an issue with cash. The correlation, remember I said when you're looking at parsimonious, whether something's a separate asset class, you're looking at something unique related to return, risk, and correlation. Well, cash tends to have an unstable correlation with other asset classes, but cash tends to do very, very well in a crisis, like 2020 with COVID-19, or 2008 or 2000. Cash tends to hold up well when the stock market's crashing. It doesn't normally make you a high return, so it's not going to be up 8-9%, but it won't go negative. So at least when stocks are down 30%, you've made zero or close to zero. You're at least happy. But cash tends to be held for liquidity. So holding place, when you don't know exactly what you want to invest in, you hold it in cash, wait for the markets to fall, keep your powder dry, as they say, and then once the market falls, then you have the ability to go out and buy securities. All right, now let's get into my favorite topic. Let's talk about bonds. So here for bonds, we're going to use the DC cuts I. So the D, and just tell you real quickly what they are. The D is duration. That's the first one we're going to talk about. C is convexity, by far the hardest. The second C is credit. The next C is U for US versus non-US. The T is for taxes. The S is for structured debt, and the I is for inflation. I think this is a great, great list. If you remember this list and you can go a deep dive in what we're going to talk about now, you should be able to handle most questions related to bonds in any interview. So let's get into it. Let's start with the very first one. So bonds, we talked earlier, bonds is when you're loaning money to governments, to corporations. It's the same definition as cash, except for it has longer maturities. So with bonds, there are 7 sub-asset classes. The first sub-asset class is duration. So we're going to start with duration. So remember the approach. So you want to first give a definition of the term duration. Here's the definition. You then want to talk about the sub asset classes, subcategories. Here they are. And then you want to talk about the strategy. The strategy is on the next page, so I'll have to get that to you. So the definition of duration is, the technical definition. It's the weighted average time to maturity using discounted cash flows as the weights. I'm going to actually show you this formula when we price bonds later in the class. But essentially what duration is, it's a measure of how sensitive a bond is to changes in interest rates. So duration is the measure of price risk for a bond. Price risk and interest rate risk are the same thing for a bond. That is a measure of how sensitive the price of the bond is to changes in interest rates. And we use this formula to express it. So the percentage change in the price of the bond equals about minus that bond's duration times how much interest rates have changed. And you notice it starts with a minus sign. Why is that? Well, because with bonds, when interest rates rise, bond prices fall. We'll definitely see that later in the class when we price bonds. So when interest rates rise, bond prices fall. When interest rates fall, bond prices rise. So that's why it's minus duration times the change in yield. Now before we get into, we'll do a little bit more of this and get a little more practice with this, especially when we get into convexity. But there are three subcategories for bonds under duration: short-term, intermediate term, and long-term. Short-term have low duration. They have very low exposure to changes in interest rates. Long-term have high durations, or they're very sensitive to changes in interest rates. All right, so there's your three subcategories. I heard the history of this short-term, intermediate term, and long-term, that this was something that Vanguard, the second largest investment firm in the world, these were terms they first coined and used with their mutual funds, and it just stuck, and everybody uses that as well. So let's get into duration a little bit more as a measure of price risk. So I gave you this formula right up above, so I want to keep it here so you can see it, and then I want to do some practice with it. So a bond with a duration of 5 years would be expected to see its price fall 5% if interest rates rose 100 basis points. Now, what is a basis point? We talked about it in our second class, so hopefully you're remembering it. You divide by 10,000. So 100 basis points would be 100 divided by 10,000, or 1%, 0.01. All right, so what would happen if interest rates were to rise 100 basis points, or 0.01? So the duration is 5 years, so you take minus, and it's a positive duration, so minus 5 times plus interest rates rose 1%. So you would expect this bond to fall 5% in price if interest rates were to rise 100 basis points. So what if the bond had a duration of 8 years? And what if interest rates were to rise 200 basis points? In that case, you take minus 8 times 0.02, 200 basis points, 200 divided by 10,000 is 0.02. So you'd expect that bond to fall 16%. What if interest rates were to fall 150 basis points? 150 basis points is 0.015. So you do minus positive 8 duration times interest rates fell, so times minus 0.015. In that case, you expect that bond portfolio or that bond price to rise 12%. That's what duration is telling you. So in general, the yield curve is upward sloping. So longer term bonds, yeah, they're more risky. They're more sensitive to interest rate changes, but they tend to give you higher returns. They tend to give you higher yields, so you're getting paid to go out further in duration. So when you take on more price risk, higher duration, you usually increase the expected return of your portfolio. So what I want to do is I want to show you what we call the yield curve. Hopefully you have the yield curve in your 3013 class and talk through it, but I want to show you the yield curve. So you can just type in Treasury yield curve, and this site right here is one that will come up. It's a really great site. They give you a bunch of interest rates, so 1 month, 2 month, 3 month, 6 month, 1 year, 2 year, 3 year, 5 year, 7, 10, 20, 30. You see there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. They have 12 points. Usually a yield curve will have 11 to 12 points. I think here they have 2-month here. I don't usually see 2-month on yield curves, so you usually have 11 points and not have the 2-month in there. But what you'll notice, and these numbers are just absolutely crazy, what you'll notice is how low the short-term rates are. So this is not 7%. This is 0.07%. This is what we call 7 basis points, 0.07%. This is 1.66%, and you notice what we call the term structure for interest rates. As you go out in maturity, you notice that interest rates are rising. They get higher. Today, interest rates up a little bit on the short end, not much, just 2 basis points. On the long end, they really haven't moved much at all. They've gone up just 1 basis point, and the 20-year hasn't moved at all. The 10-year is up just slightly in yield. Now you can go back in time. You could go back to 2019, and you look at the beginning of 2019, and what you'll notice is that the yield curve was really very, very flat there. You notice that the 1 month and the 10-year were not that far apart. Compared to what we just saw before, we see the 10-year at 140 versus 7.07. The 10-year was like almost 0.9% higher than the short term. But here, the 1 month and the 10-year were really not that much different. And in fact, the 1 year is almost the same as the 10-year, and the 1 year is even higher than the 7-year. If you go back to, say, like a year like the end of 2007, what you'll notice in a year like you see the 2 month, I'm not used to the 2 month, and they just added the 2 months. So, but here what you notice, especially when you get further in, here you notice that the short term is actually higher than the long term. When is the short term usually higher than the long term? You saw that through 2007, especially right in the summer, where the short term was higher than the long term. Well, when short term rates are higher than long term rates, that's called an inverted yield curve. You should have seen that in 2013. What an inverted yield curve is telling you when short rates are higher than long rates is that the bond market expects a recession within the next year or so. And sure enough, in 2008 we got a recession, so there the bond market called it very, very, very well. Now if we go back to 2020, well, let's go to the end of 2019 again, and let's go to the summer of 2019, and then you have to ask, did the yield curve invert? And sure enough, the yield curve was inverted back then. Now, I remember a lot of people saying, well, the yield curve's inverted, but we're not going to have a recession this time. This time the yield curve is wrong. This has to do with Fed policy and what the Fed's doing. But sure enough, the bond market, 1 year out, predicted the 2020 recession without even knowing anything about COVID-19. Pretty amazing. The bond market, when the yield curve inverts, people get really nervous because that's a prediction of a recession. You can see in 2007, yield curve inverted. We had a recession in 2008. You can see here in 2019, the yield curve inverted, and we had a recession in 2020. And we've never had a recession without an inverted yield curve. We have had some inverted yield curves that did not get followed by a recession, but every recession has had an inverted yield curve before. Even 2020, as surprising and shocking as 2020 was, came out of nowhere. The bond market still saw it and predicted it. So what strategy should you have related to duration? So you've defined duration. You talked about the 3 sub-asset classes: short-term, intermediate term, and long-term. Now you want to give the tactical strategy that you would want. So with duration, your whole focus is on interest rates. Are they rising or falling? So if your boss believes interest rates are going to rise over the next 12 months, you want to shorten duration, right? Because remember, when interest rates rise, bond prices fall, and the longer the duration, the more the bond price is going to fall. So if you're expecting a significant rise in interest rates, you would want to immediately say, we need to shorten the duration of our portfolio. So if you get an exam question, if you get an interview question related to this, then you're ready. Interest rates rising, you want to shorten duration. What if your boss believes interest rates will fall dramatically? Then you want to lengthen duration. And these are the correct terms. Shorten duration, lengthen duration. We don't say make duration less. We don't reduce duration. We shorten it. We don't say we increase duration. We say we lengthen it. I don't know who picked these terms, but there's some jargon you need to learn as a finance major, for those of you that are finance majors, and that for some reason is the jargon. Shorten duration, lengthen duration. So let that sink in and make sure you're comfortable with that. So just to recap, define duration. It is the weighted average time to maturity using discounted cash flows as the weight. We use the formula minus duration times the change in yield to show us how sensitive a bond is to changes in interest rates. The sub-asset classes are short-term, intermediate term, and long-term. And then the strategy is you expect rates to fall. You want to lengthen duration. You expect interest rates to rise. You want to shorten duration. All right, so we've gotten through our first big piece of this template I'm giving you, and hopefully you're going to hear me say this over and over again, those three components that you want to talk about under each one. So let's jump into the crazy one, convexity. Convexity is not related to the change in interest rates, but more into the volatility of the change in interest rates, how rapidly rates change. Not so much if they're going up or down, but how rapidly they change. So convexity is the second order change in a bond price. It's kind of like the second derivative. A bond price is the interest rates, where duration is the first derivative, convexity is the second derivative. Bonds do not move in a straight line the way duration implies. Most bonds have a convex shape. And so what that tells us is that bonds do not move exactly like duration would have you think. There's a spreadsheet I provided you that you could experiment with that's on Blackboard that allows you to play around with duration and convexity. But a former student actually built me a website. I think he used Python to do this. Built me a website so you could actually go to his website and do this as well. First thing I want to do is I'm going to put my maturity at 10 years. My coupon, we'll talk about the coupon later, but this is what the bond pays you every 6 months, 5%. And the yield is what the current interest rates are. So the coupon is what the bond's paying you, probably when it was issued, interest rate. So this 10-year bond might be a 20-year bond that was issued 10 years ago. So it only has 10 years left. And so when it was issued 10 years ago, interest rates are much higher, 5%. The yield is 2%. And then you look at the output. It shows you, and we'll definitely do this in class. We're not going to do the convexity column, but we're going to do this in class. So we'll do this not until exam 2, but you'll build this schedule in your on your exam. It calculates everything we need, including the price for this bond. And so we'll look at the output. So we can see this bond is trading for $1,270. It's a $1,000 bond, but it's trading at a 27% premium. We'll talk about that. It has a duration of 8 years. That's a pretty long duration. And it has a convexity of 83. Now, is that a high convexity or is that a low convexity? So 83. So we'll look at that. But what you'll notice in this chart is this blue line is what we'd expect that bond price to have done if duration explained everything. So minus duration times the change in yield. As interest rates fall, the bond price rises. As interest rates rise, the bond price falls. But convexity explains this green line. You notice the green line is very, very close to the blue line as long as interest rates don't change much. As long as interest rates don't change more than 2% up or down, the green line is very close to the blue line. What that means is when interest rates don't change much, duration tells you essentially everything you need to know about a bond's sensitivity to interest rates. But what you'll notice on the extremes, when interest rates move a bunch, the green line is much higher than the blue line. both when interest rates fall, you get positive convexity. Important term there, positive convexity, when interest rates move down a bunch. You also, even though you lose money when rates rise, you still get positive convexity. You don't lose as much money because you have positive convexity. Now remember that convexity number, 83, and I'm going to make this a 30-year bond that has a 0 coupon. Now look at convexity. Convexity jumped from 83 all the way up to 914. The duration is very, very close to 30 years. Look at all that convexity. And this is a huge advantage of a zero coupon long-term. This is a 0 coupon bond. It means it doesn't pay any interest at all. You buy it today for $550, $45, and in 30 years you get $1,000. But this is how the bond price would move if interest rates rose or fell. Interest rates rise, you lose money, but not nearly as much as you would expect given duration. So this is a great little website to play with. Or load the Excel file I have if you really want to get into the calculation of how we did duration and convexity. And these calculations, you can just see how that number comes up. This isn't the actual calculation of convexity. This is just part of the calculation. There's a lot more calculations you've got to do. This is the calculation for duration. You just add these numbers up and you'll get that 817. So I'll show you how to do this later in class. But pretty cool stuff. All right, so convexity is a very tough topic, and it's a very tough topic mainly because there's so much we can do with this topic. It's almost an endless topic. But I'm going to cover what the most important part of this is. There's a lot more to it that we're going to cover here. But probably the single most important concept related to convexity is special type of bonds that have what we call embedded options. So some bonds provide the borrower, not you, you're the investor, you're loaning money to a borrower, but some bonds provide the borrower the option to pay off the loan early, that they can prepay the loan. They can pay off the loan before maturity. Now this isn't true for Treasury bonds. The U.S. government cannot pay off its debt early. It could buy its bonds back, but it has to buy them back at the market value. If that $1,200 I showed you, if the bond's market value is $1,200, the federal government would have to pay $1,200 for that bond. They cannot just pay off the bond at $1,000. They have to keep paying that 5% until the bond matures, or they have to buy the bond back at $1,200. But there are borrowers who have the right to pay off their debt at what we call par, at the $1,000. A good example of those are callable bonds and mortgage-backed securities. We're going to spend most of our time talking about mortgage-backed securities. But callable bonds give the borrower, usually a corporation, the right to pay off their debt early at certain times, maybe not in the first year, maybe not in the second year. They may have to pay a little bit of a penalty to do it, but it gives them the right to pay off the note early. Mortgage-backed securities. So we'll talk about mortgage-backed securities, but you know what a mortgage is. You borrow money to buy a house. A mortgage allows you at any time to refinance. That means you get to pay off your debt at par without maybe a little bit of a penalty, but just a little bit of a cost and points that you have to pay to refinance. And you also have to pay for, assessment of the property value, and you may have to buy some title insurance, which I think is a terrible ripoff. But there's certain things you have to do, the appraisal, so there are some costs of doing it. But for you as the lender, you don't like this at all. You loan someone, say, $300,000 to buy a house, and they're paying you 7%. So you've got a $300,000 investment paying you 7% for 30 years. You're really happy, and an mortgage rates fall to 3%. And that person comes and says, here's all your money back. I'm going to pay off the loan early, and I'm going to go out and borrow at 3%. And now suddenly you got all those hundreds of thousands of dollars back. You had it locked in at 7%, and now they paid off their debt early, and they gave you all that money back, and now all you can do is reinvest at 3%. You're pretty upset. So this is where it gets crazy, and this is where I really love this part. We'll probably have to take some of this into the next class session. But You as an investor, essentially what you're doing when you buy a mortgage-backed security, and I'll talk about what that is here in a little bit, you're essentially buying a regular bond, we call it a straight bond, a bond without the option, and then you're essentially selling a call option on interest rates. We're not going to talk about options until the end of the class, but essentially you're selling someone the right to do something. Now you like that, you're selling it, so that means it's increasing your return. You're getting extra money up front. But when you sell an option, that's great unless the borrower executes on the option. And when will that borrower execute on the option? Well, only if it's in their interest. So if they have a mortgage with you at 7% and interest rates go from 7% to 10%, so now they have a mortgage at 7 locked in, but mortgage rates today are 10%, they're going to keep paying that 7%. They're not going to pay off that loan early. They love their 7% because interest rates are 10%. They locked in a good rate. They're happy. But if they borrow money from you at 7% and then mortgage rates drop to 3%, they are definitely going to refinance that debt and give you all your money back. So it's an option that only gets executed to your detriment as the investor and only gets executed to the benefit of the borrower. So why is this important? Why am I using the word option? Isn't that too advanced for this class? Well, maybe it's a little advanced, but you can handle it. But the reason I bring that up is option prices rise when volatility rise. So when the volatility, we call it underlying. We're going to talk about this more later in class, but in this case, we're selling options on interest rates. So when interest rates become more volatile, that option we have on interest rates is going to rise in price. I mean, you say, well, that's good. Well, no, it's not. Remember, we're selling the option. So you sell a call option. You definitely don't want its price to rise. You want its price to fall. When will an option on interest rates price rise and harm you? Whenever interest rates get volatile. So selling interest rate options is bad when interest rates become more volatile. Highlight that in your notes. Extremely important. So what does all this mean? How do we bring all this together? So let's start talking about the easier ones first. So convertible bonds, we're ignoring those entirely in this book. If you bought the Fabozzi book, he has an entire chapter at least on convertible bonds. I'm not a convertible bond person, didn't really ever deal with them much. There's an entire investment strategy out there, hedge funds, called convertible ARB. If you're interested in that, you can look it up. But that's when people can take the bond and they can convert it into equity of the company. So very, very unique, very specialized area of finance, has some really quite complex mathematics behind it, no question. Callable bonds is a corporation borrows money and it's a callable bond. And after 2 or 3 years, after some lockout period, they're allowed to repay that bond, maybe at a premium. So maybe in 3 years, they have the right to pay off the bond at 102. So they have to pay a 2% premium to pay it off. When would they do that? They're only going to do that if interest rates really fall dramatically. So why would they pay an extra 2% penalty? Well, if they were borrowing at 7% and now they can borrow at 2%, they'd be better off paying off that debt at 102 and reborrowing at 2%. There's some terms here that you can definitely look up. I might bring them up here a little bit later, but one term in particular that you might look up is the phrase yield to worst. Yield to worst, YTW. So there's yield to maturity and yield to worst. If you want to learn this even better, definitely yield to worst is directly related to callable bonds. So if you want something to look up on the internet to go deeper on this topic, yield to worst would be a good way to look up that term. Look and get deeper. All right, let's get to the third category. So we have convertible bonds, we have callable bonds, and now the third category, which is extremely important one, which is mortgage-backed securities. So what is a mortgage-backed security? Well, you need to know what an asset-backed security is. I include mortgage-backed securities as part of asset-backed securities, but I've noticed the Fabozzi book and others, they make asset-backed securities and mortgage-backed securities as two different things. I always think as mortgage-backed as being a special case of asset-backed. But what is an asset-backed security? Well, banks make loans. They make loans, mortgages loans. They make credit card loans, make auto loans. Well, banks don't really want those loans on their balance sheets, especially mortgages. Mortgages are, 20-year, 30-year mortgages. Banks are short-term entities. They don't want 30-year loans on their books. And so what they do is after they make all these mortgage loans, they take all their mortgages, they go out to the market, they bundle all their mortgages together and they put them into a trust. The trust then gives the bank money for all of their loans, and then the trust goes out, well, the trust goes out and borrows money. They take that money, they give it to the bank. So essentially the bank has gotten all of their loans prepaid. So they get all their money for their loans today. The trust borrows money, and the money they borrow, they're going to pay that back by simply passing through all the cash flows on those mortgages. So what the bank has done is taken a very illiquid security and they converted it into a security by making a mortgage-backed security or asset-backed security, and the bank gets all their money. They've essentially gotten all their debt to pay off, and they've taken all those bonds and put them out to the market, to the capital markets. This is known as securitization. That's another term you could definitely look up in Google. Man, I'm giving you a lot of terms to go out there and look on the internet, but securitization. It was a big part of the 2008 financial crisis. You might have heard the term shadow banking. You might look that term up. But what that means is banks look like they're loaning money, but they're really not. They're making the loans, but they're taking those loans, bundling them up, and getting them off their books. And it's going to the securitization market, which some people call is like a shadow banking. It's like shadow banking. It's all these loans are happening, but they're not banks doing them. The banks originate the loans, but they don't really keep them. They put them out there to the market. So the 2008 crisis obviously was mortgage-backed securities, but in particular subprime, the riskiest mortgage-backed securities. That's what blew up in 2008 and caused problems just throughout the entire financial community. So the trust will take all those loans and pass them through to the investors. These are also known as pass-through securities, because the trust just says, hey, whatever I get from those mortgages, if I have 100 mortgages, whatever they pay us, that's what we pass on to you. If they prepay their mortgage, if they refinance their mortgage, then you're going to get that prepayment. If they don't prepay it, then you're going to be stuck with whatever happens. So essentially, you as an investor, you're getting the habits of all of the mortgages that are in that trust. Mortgage-backed securities is an asset-backed security with very low and actually negative convexity. Remember that 30-year bond that I showed you that had like a 900 and something convexity? Well, mortgage-backed securities can have negative 300, negative 400 convexity. What that means is, with this chart right here, we've seen positive convexity. If this were a mortgage-backed security, we'd actually see the green line, come down below the blue line. Why? Because when interest rates fall, instead of your bond price going up to $1,200, instead that mortgage person, the borrower, the person with the mortgage, they're going to pay that mortgage off for $1,000. So you can't get $1,270. They're going to pay their mortgage off early, and so you're just going to go flatline. And then when interest rates rise, you might have had someone that had a mortgage, and maybe they're making an extra $200 payment a month. They listened to Susie Orman, that famous financial advisor, and she said, take your mortgage and pay off an extra $200 every month to get the mortgage paid off 5, 6, 7 years faster. And so that person, they borrowed at, say, 5%, and they're making that extra $200, but then interest rates shoot up to 9 or 10%, and they say, you know what? I'm not going to make that extra $200 payment a month. I'm going to take that extra $200 and buy 8, 9% CDs because my mortgage is 5%. And so when interest rates rise, the bond will even do worse because you have what we call extension risk. So mortgage-backed securities will have a line that is not convex but concave, and actually hurts you. So you can see how positive convexity helps you on both sides. Negative convexity hurts you on both sides. So think about positive convexity, negative convexity. So mortgage-backed securities have negative convexity because when interest rates fall, borrowers refinance. That's called prepayment risk. When rates rise, borrowers make fewer extra payments. That's called extension risk. Many mortgage-backed securities have very low credit risk. but they still provide a spread that has extra return over treasuries, even though they're not really riskier from a credit standpoint. And why is that? Well, it's to compensate you for the option that you just sold. So here's another term you can definitely look up. This is a great one. You type this term in Google, you will find some websites that will just blow your mind when you see how much there is to learn about bonds. That's why I say you can make a lot of money being a bond portfolio manager or a bond analyst, because it gets so complex. And as I always tell students, finance pays you for complexity. Find the most complicated thing that you can stomach, get a job in it. It's going to scare you, freak you out the first few weeks on the job because it's so complicated. But after you work 45, 50 hours a week for 3 or 4 months, you're going to learn it and you're going to know it so well, you become an expert, and you're going to be worth a lot of money because you understand this stuff, because you see it every day, it becomes second nature. You'll have no trouble making 6, 7 digits in finance. And that's the advantage of bonds. These type of bonds have so much complexity to them, you can really become an expert in this area. So what is option adjusted spread? Well, option adjusted spread is the spread mortgage-backed securities would have if they didn't have that optionality. If you took the optionality out, you did not allow people to pay off their mortgage early. If you took that out, that's what the spread on the mortgage-backed would be. So what that means is a mortgage-backed is paying you a spread. Part of that spread is you giving the borrower the right to prepay early. So they're going to pay you that option premium. The rest of the spread is essentially a credit spread, or maybe it's a spread just because of modeling issues, what kind of risk that you're looking at. But option adjusted spread is a very unique term related to mortgage-backed securities especially. In fact, if you type that into Google, you'll probably see the term mortgage-backed security come up. You'll probably see the term convexity coming up. So what I want to do, I want to let this sink in. And then next class, we will get into this. Before I cover this part, I'd really like some of you to go out and Google these terms, see what you find. And then when we have the class session, the actual live class section, I want to hear some of your questions. Challenge me, ask me some good questions. And I'll give you a question that I've asked. I might cover it next class. I've asked, there's a lady at UTSA who ran our Ginnie Mae fund, which is a mortgage-backed security fund. She has a PhD in math. And I asked her a question once, why do Ginnie Mae's have an OAS? And you might think about that. Why do Ginnie Mae's have an option-adjusted spread? And she found that a really great question. I can't remember what her answer was. I think I actually kind of stumped her on that question. But I have a theory I might tell you about. But look at some of these terms. Get excited about this stuff. If you're in this as your career, for those that are finance majors, if you're bored with this stuff, then change majors. But if this is what you signed up for the next 50 years, go out and expand your mind. Think about this stuff beyond just what we're doing in this class. Expose yourself to the fact that this stuff is far more complex, and get excited about it. Don't let it depress you. Get excited about it. Your attitude should be, wow, I could take this as a job and learn this, and in 2 or 3 years, this stuff would be so easy for me. This stuff that seems so scary right now would be so easy for me. After that, I can name my salary at any job I want. So pretty exciting stuff.